Today we're visiting our favorite coffee shop in downtown Fort Langley, British Columbia. I want to use this business as a reference when we're looking at accounting transactions and how to build our financial statements. So accounting transactions we'd have to consider. So for example, when the shop first opened in 1987, what business transactions might they have encountered? If you were to start a new business, how would you finance your startup? How would you show your bank loan, your investor funds in your financial statements? How would you, the bank, or your investors actually determine if your business is making any money? And what if you wanted to buy some new equipment or hire some new employees? It's important to understand the language of business and be able to represent this information in your accounting statements. Today, we're talking about the accounting equation. Assets equal liabilities plus shareholders' equity. So let's make sure we understand the elements of the accounting equation. So here we have under assets, these are the resources or the stuff that the company owns or controls that provide future benefit to the company. So they're going to be things such as cash, things maybe like equipment or supplies. It could even be vehicles. And let's say vehicles. All of these things providing the company long-term future benefit. Next, we're going to look at this side of our accounting equation. We have liabilities. Now, these are two groups that have claims to all of these assets. Here we have the lenders or other creditors, and this is going to appear as liabilities on the balance sheet. And then over here we have our shareholders, and that will be under shareholders' equity on the balance sheet. And just to remind you that when you look at the balance sheet, the shareholders' equity section is broken down into two parts. The first is share capital. And these are the amounts that our shareholders contribute to the company. The second section, though, is retained earnings. Retained earnings. And these are amounts that are retained or accumulated, aggregated within the company from profits. So keeping in mind the bookseller and the cafe that we looked at earlier, I want to look at a few examples then and then actually work through some transactions using that accounting equation and making sure that we keep it in balance. So let's start with our first example. Let's say that our cafe has $175,000 worth of assets, and our liabilities are $55,000. To keep this in balance, what would have to be the amount of shareholders' equity? $120,000, right? Because we want to keep assets equal to liabilities and shareholders' equity. Okay, let's try a second example. Let's assume that liabilities in this case are $170,000 and our retained earnings are $100,000 and our share capital is $90,000. My question is, what would assets be? In this case, assets are going to be $360,000. Let's look at some individual transactions and see how they're going to impact the accounting equation. So our first example is, what if the owners invests $55,000 into the company in return for common shares? Let's see how that's going to look on the accounting equation. So what does the company get? The company in this case is going to get $55,000 cash, and cash is an asset, which I've abbreviated as A here. So it's going to get $55,000. And what is the company giving up? Well, they're giving up common shares, which goes under our share capital, and that's $55,000. So common shares have gone up, and the cash in the company has gone up. Okay, let's look at example number 2. So the company purchases on account a commercial espresso machine of $5,750. How's that going to impact the accounting equation? What are they getting? They're getting an asset. They're getting a machine that the company can use and have future benefits. So it's an asset, and it's going to go under assets at $5,750. And we have to keep this in balance. So where is that going to go on the other side? Well, it's not impacting shareholder equity. It's not impacting retained earnings or share capital. But what it is impacting are liabilities. They've purchased that on account, so they're going to be owing that in the future. So our liabilities have gone up and our assets have gone up. Okay, example number 3. So the company is going to borrow $1,000 from the bank. So what is the company getting? In this case, they're getting cash. Cash is an asset. So cash in the company is going up $1,000. That's my arrow just to indicate it's going up. And to keep this in balance, where are we going to record? It's not shareholder equity. In this case, again, it's a liability. And it's going to be a bank loan payable. That has gone up $1,000. So their liabilities, their debts have gone up $1,000 and their assets have gone up $1,000. Okay, example number 4. In this case, the company is going to pay for that espresso machine. Remember they'd bought it on account? Well, now they're going to pay for it. So in this case, let's just erase this off. What's happening to our cash in this case? Well, our cash is going down by the $5,750. Our cash has gone down. We've got to keep this in balance. What else is going away? The liability or the debt. So this is also going to go down $5,750. Our accounting equation is still in balance. Example number 5. So in this case, the company is going to buy $3,000 worth of inventory. Let's say they've gone out to buy books to put on their shelves. So what's the impact on the accounting equation? Let's erase this one. So what is happening to the cash in this case? Right, our cash is going down, and we said this was $3,000. Our cash went down. We've got to keep this accounting equation in balance. So what do they get for that cash? They're getting inventory. Well, in this case, they're getting inventory, which is also an asset. And so assets went down in terms of their cash, but assets went up in terms of inventory. The accounting equation is still in balance. Okay, example number 6. In this case, the company is going to hire an employee to work next week. What is going to be the impact on our accounting equation in that case? There is no impact. In that case, there's been no economic transaction, so there's no recording required on the accounting equation. Okay, example number 7. We're going to pay $300 wages for an employee. And so what is happening again to our cash? Well, our cash is our asset. It's going down $300. And we've got to keep this in balance. So it doesn't involve liabilities, no debt to our creditors. It doesn't include any share capital, no common shares. So it falls under retained earnings. And if you look back at your statement of shareholders' equity, you'll see that profit is one element of retained earnings. Profit is revenue less expenses. In this case, this is an expense. It's an immediate cost to the company. It doesn't have long-term benefits, so it's not an asset. And so it's going to be considered an expense. It's $300. And the impact of that expense is that it brings down shareholders' equity. And so here we have our accounting equation is still in balance. Okay, example number 8 and our last example. We are going to record the daily sales, $2,300. And so how we're going to do that? So our sales, again, we're impacting cash. And so cash, $2,300. Our assets have gone up. There's no impact on liabilities and no impact on share capital, so we know it falls under retained earnings. Let's look at what the elements of retained earnings are. It's not expenses, because we just did that. When we're recording daily sales, it's going to be revenues. And so this is going to impact revenues, $2,300. Revenues increase shareholders' equity, so our accounting equation is still in balance. Okay, so it's important to understand with those individual transactions how to keep that accounting equation in balance. Next, we're going to move on to expanding that accounting equation, which is going to lead us into journal entries. And we'll be prepared for posting those journal entries and creating financial statements. See you soon.